Hello and welcome to AI Market News by LM. Before we jump into today's deep dive, just a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, let's delve into the global financial markets. We're setting the stage for a comprehensive deep dive today, exploring the fascinating world of global currency movements, taking a close look at U.S. equity performance, and dissecting the major macro indicators that are really shaping investor sentiment right now. Our mission, essentially, is to pull out the most important insights from our prepared resources, giving us all a shortcut to being well-informed about what's happening.
Absolutely, and what's fascinating here is just the sheer dynamism, the interconnectedness of global markets right now. We are, truly at a captivating juncture. You've got significant shifts in monetary policy expectations, especially from the Fed, colliding with evolving geopolitical developments.
Right.
And this convergence, it's influencing everything, really, from tech stock surges to record highs in gold prices. It's creating both remarkable opportunities and, frankly, considerable uncertainties for us to navigate.
Diving straight into the U.S. equity markets, then. It's been a bit of a mixed picture, hasn't it? The S&P 500 has been hitting new records, crossing 6,600, and it's even looking towards that 7,000 milestone with, 73 trading days left in the year?
Incredible momentum on the surface, at least.
Exactly. And the NASDAQ, it's not being left behind. It's achieved its longest winning streak since 2023, largely fueled by some really strong tech performance. We've even seen Alphabet join the exclusive $3 trillion market cap club. That's the fourth company after NVIDIA, Microsoft, and Apple.
Yeah, fueled by those favorable court rulings and, of course, the AI demand-boosting earnings.
Precisely. But here's the catch. Based on the information we have, while 46.6% of stocks are advancing, almost half, 49.8%, are actually declining. So it signals a rather mixed, broader market despite those big headline index gains.
And zooming out, the implications of that are significant. The market's upward path, yes, it's linked to decreasing volatility. The VIX, the so-called fear gauge, has dropped to lows we haven't seen since 2022. That suggests a kind of market calm, with investors anticipating Fed easing.
Right, the calm before the potential storm.
Maybe. And look, the S&P trading above its 125-day moving average, that's a classic positive momentum sign, as seen in the prepared resources. However, and this is crucial, think about the concentration risk. Around 40% of the S&P 500 index is currently sitting in just the top 10 stocks.
40% in 10 stocks. So we're seeing these headline gains, nearly half the market declining, and this heavy concentration. Does this mixed market picture sort of amplify that concentration risk you mentioned? Does it make the overall market maybe more fragile than the record highs suggest, almost like two different markets running side by side?
Precisely. I think that's a great way to put it. For investors, that apparent calm from the low VIX might be, somewhat misleading. The overall index looks strong, sure, but it's really being held up by a few giants. It's so important to look beyond the headlines and understand just how narrow this rally is. A stumble by even one or two of these big players could have a really outsized impact on portfolios and sentiment. It creates this dynamic where the overall market health is perhaps less robust than the index numbers alone would suggest.
That's a really significant point about potential fragility. And speaking of how companies operate, how they talk to investors, there's this fascinating regulatory shift possibly coming. We're seeing President Trump's proposal now prioritized by the SEC, apparently to change mandated corporate earnings reports from quarterly to semi-annually.
Ah, yes, echoing his 2018 push. The idea is to reduce regulatory burdens, cut costs for companies.
Right. But what are the deeper implications here?
Well, this change is definitely a double-edged sword. On one hand, sure, it could allow companies to focus more on long-term strategy, reduce overhead, like some business leaders argue, but it raises a really crucial question about market transparency, doesn't it?
Fewer updates means less visibility.
Exactly. Fewer reports might lead to greater volatility when those updates do land, and just generally less visibility for investors day to day, even if, material changes still technically require timely disclosure.
So companies get some breathing room, maybe focus longer term. But investors get less frequent data.
Yeah.
How do we square that? That desire for deregulation versus the fundamental need for, consistent market information.
It's that classic tension, isn't it? The argument for less frequent reporting often centers on encouraging long-term thinking, reducing that short-term market pressure. But, in today's fast-moving world, investors often rely heavily on those quarterly check-ins to gauge performance, assess risk, make informed decisions. Reducing that cadence really shifts the information dynamic significantly. It could potentially lead to more speculative trading around those fewer reporting periods. It's deregulation meeting the need for information head-on.
Okay, let's pivot then. Let's talk about the Federal Reserve. The meeting starts today, Tuesday, September 16th, U.S. time. The big decision, the dot plot, that's expected tomorrow evening, Wednesday the 17th. Now, a 25 basis point rate cut, 0.25%, that's almost entirely priced in by the market. Some analysts are even calling for a bigger 50 basis point cut.
Which would be the first cut under a potential second Trump term, interestingly.
Right. And the Fed's dot plot projections, they're expected to signal 3 rate cuts by the end of 2025, then maybe a slower pace in 2026. It looks like a shift towards what people are calling insurance cuts to counter a weakening labor market.
And this really shines a spotlight on that critical question about the Fed's independence, especially given the politically charged environment. Based on the prepared resources, we've seen things like the confirmation of Stephen Barron as a Fed governor, but at the same time, a court blocking President Trump's attempt to fire Governor Lisa Cook. It just highlights how tangled monetary policy has become with politics.
So a 25 basis point cut seems baked in, signaling that dovish shift. But you're highlighting this significant political pressure. How much real independence does the Fed actually have in this kind of climate, particularly with potential second Trump term looming?
That's the absolute core tension right now. Our sources suggest there's been a noticeable erosion in the perception of independence. Some Fed statements already seem, more dovish since Trump really ramped up his rhetoric against the central bank. There are genuine concerns that this political pressure could push the Fed into a stance that's, let's say, more accommodative than orthodox economics might dictate.
Undermining the inflation fight.
Potentially undermining the commitment to fighting inflation and that 2% target. The market is watching this incredibly closely. Because if that commitment is seen to weaken, it could, paradoxically, lead to long-term yields actually rising, which impacts everything from mortgages to corporate borrowing.
Okay, let's turn to the currency markets then. The U.S. dollar index, it's hovering near a 2-month low right now. This dollar weakness, we're seeing it translate into an upward trend for the euro against the dollar, and also notable strength in the Japanese yen. Euro USD is trading around, 1.17762, showing that upward move, while USD JPY is around $147.47, reflecting yen's strength.
And the wider context here, it connects right back to the Fed. That expected dovish shift is clearly undermining the dollar's appeal. This dollar weakness is increasingly viewed as a kind of safe trade, and it's helping create an environment that's pretty conducive for emerging markets.
Oh, interesting. So EMs are benefiting.
Yes, emerging market currencies and stocks have generally been outperforming. They're supported by this renewed appetite for risk, and it's also helped by the relative strength of the Chinese yuan, which, remember, has been an epicenter of this whole AI development boom. And of course, we can't ignore gold hitting new record highs again. That reflects a broader flight to safety amid fears about fiat currency debasement and those persistent global fiscal deficits.
Now, as we're thinking about these internal market dynamics, it's impossible to ignore international trade and geopolitics. They're exerting a huge influence. Delicate negotiations with China, strategic alliances, global power plays are directly hitting financial sentiment. On that front, we saw a framework deal reached in Madrid to keep TikTok running in the U.S. That's expected to give Asian markets a bit of a boost, sentiment-wise. And this breakthrough apparently sets the stage for a phone call between President Trump and China's President Xi Jinping on Friday, September 19th. Trump's framing it as a potential big deal.
Well, yes, the TikTok agreement is definitely a positive step, but it's widely seen as, let's say, medium importance or maybe even low-hanging fruit in the grand scheme of things. According to the input sources, China is still applying pressure elsewhere. We just saw them rule against NVIDIA over an antitrust issue with its Mellanox acquisition back in 2020. And they've initiated anti-dumping investigations into some U.S. semiconductors.
Right. So even with the TikTok deal happening, China's taking these other more aggressive actions against U.S. tech. Does that signal perhaps the broader strategy of leverage, taking these actions even while negotiating, or are these just separate issues?
That's the crucial question, isn't it? The old deal on everything idea in these complex relationships suggests that many issues remain deeply intertwined. China's actions, even during what looks like trade progress, can certainly be read as demonstrating their continued resolve and leverage. It signals that, resolving one specific issue doesn't automatically mean the broader strategic tensions just melt away. For international companies, it just means navigating a landscape where policy and geopolitics are constantly shifting.
Shifting focus again, another diplomatic front. President Trump is undertaking a state visit to the UK. He's set to unveil economic deals worth over $10 billion there. That includes a pretty chunky $5 billion investment from Google in the UK over the next 2 years, specifically for AI demands.
Yeah, focusing on science, defense, financial services.
So what's the context here?
Well, analyzing this visit, it's definitely presented as a great vote of confidence for the UK economy, particularly in those key areas like AI and nuclear investment. But we also have to remember the domestic backdrop in the UK. Things like employment numbers, inflation are still concerns. British businesses, they're looking for certainty on existing trade elements like those steel and aluminum tariffs, and generally a more business-friendly approach on regulation and tax.
It's like a really delicate balancing act. The UK wants to make Trump feel positive, secure those deals, but also needs to push its own economic priorities. What are the sort of longer-term implications of mixing this high-level economic diplomacy with domestic concerns and, let's face it, potential political hurdles, like discussions around Jeffrey Epstein or Trump maybe weighing in on UK politics?
It's absolutely a tightrope walk. The immediate economic wins, like the Google investment, they're clear positives. But when diplomacy gets tangled up with domestic political narratives, it can create fragility, right? Long-term trade relationships, market stability, they usually benefit from clear, consistent policy, not just these sort of episodic wins driven by one leader's current sentiment. This constant negotiation, the potential for political entanglement, it just adds another layer of uncertainty for businesses trying to plan investments for the next 5-10 years.
Okay, moving to some other notable market movers. Gold. It's continued its impressive rally, touching new record highs again, showing gains over 30%.
Gold's strength, it's really multifaceted, and it points to some deeper anxieties out there. It clearly reflects fears of fiat currency debasement, ongoing worries about global fiscal deficits which show no sign of letting up. And what's more, China seems to be making a strategic shift towards accumulating gold, perhaps at the expense of its U.S. Treasury holdings and the dollar itself. These factors together, they seem to have considerable long-term momentum behind them, positioning gold as a pretty significant diversifier in this uncertain climate.
And in the oil markets, New York crude, WTI October, trading around $63.30 a barrel. Brent crude November at $67.44. Both have seen advances.
Yeah, this movement is driven by a real mix. You've got geopolitical risks like Ukraine stepping up attacks on Russian oil supplies, the U.S. calling for stricter sanctions. Those things tend to push prices up, the supply side worries. But on the other hand, that's balanced against forecasts of a significant supply surplus in 2025 coming from the International Energy Agency, the IEA. So it creates this really complex, uncertain outlook where short-term geopolitical shocks are constantly battling against these longer-term supply projections.
Right. Now, turning quickly to the European banking sector, some interesting developments there too. UBS is facing increased capital requirements from the Swiss government, potentially $26 billion more, with $3 billion specifically from newer, stricter rules on intangible assets starting in 2027.
That's a hefty number for UBS.
It is. Meanwhile, the Italian government has postponed tax deductions for its domestic lenders. They're aiming to raise about 1.5 billion euros in 2027 that way. But on a brighter note, BNP Paribas reconfirmed its strong net income targets for 2025 over 12.2 billion and a return on equity target of 13% for 2028.
Yeah, these really highlight both the challenges and perhaps pockets of confidence in European banking. For UBS, those increased capital requirements are substantial. It means they're now looking at a whole range of options, from minor adjustments like structured finance deals maybe, to what some are calling tectonic measures like M&A with non-Swiss banks, or even potentially relocating its HQ. That's huge, given UBS's central role in the Swiss economy.
Big deal for Switzerland, definitely.
Absolutely. The Italian government's move, well, that clearly reflects the ongoing fiscal pressures across Europe, showing how governments are looking to banks to help plug budget gaps. But BNP Paribas reaffirming its ambitious targets, that shows real confidence within parts of the sector, suggesting that despite these broader regulatory and fiscal headwinds, some major institutions are finding solid ground.
Okay, looking ahead quickly, based on Investing.com's economic calendar, it's a busy schedule. Today, Tuesday, September 16th, U.S. time, we get U.S. retail sales and industrial production data 8:30 a.m. and 9:15 a.m. Eastern, respectively. And as we discussed, the Fed meeting starts today, decision and dot plot tomorrow, Wednesday the 17th. Crucial couple of days there. Definitely. For Europe, today we saw German ZEW economic sentiment and current conditions at 5:00 a.m. Eastern, and Italian CPI data at 4:00 a.m. Eastern. In the UK, average earnings and unemployment rate data came out earlier today, 2:00 a.m. Eastern. And for Japan, the trade balance for August is due tonight at 7:50 p.m. Eastern Time. So what we've really unpacked today is a market landscape grappling with, well, arguably unprecedented political influence. We're seeing record highs driven by a very concentrated group of stocks, while shifting central bank policies and these complex geopolitical games, we've a tapestry of both amazing opportunity and significant, sometimes hidden systemic risks. It's really a time for deep, careful analysis.
Absolutely. And if we connect this to the bigger picture, that interplay between political interests and, supposedly independent central banking, it feels more pronounced than ever before. We're literally watching markets adapt to what could be a new era, where policy decisions are very deeply influenced by broader political agendas. And this raises a really crucial question for all of us, doesn't it? How will the long-term credibility of these institutions hold up in this environment? And maybe more importantly, what new strategies might investors need to navigate these evolving dynamics? Definitely something for us all to consider moving forward.
Thanks for watching. Don't forget to like and subscribe.